Welcome back to Business Vibes Only. I am Martika Lee, the founder and CEO of Just Mind Your Biz LLC. And y'all already know today is Tax Tips Tuesday. So today we're going to be discussing one of the most common yet misunderstood questions in business taxes, and that is LLC versus S Corp. You see, it's not about what sounds good or what seems fancy. It's about what makes the most sense for your money. But first, go ahead and hit that like and subscribe button if you want more information on tax tips, business strategy, entity formation, and so much more. Also, don't forget, we are officially an affiliate of NAV Prime. So if you're interested in monitoring and growing your business credit, click the link in the description. The account is free. All right. So now that we got all of that out the way, let's talk business. I think a lot of new business owners have become accustomed to the lingo of business structures. So it just sounds good to say, oh, I'm an S Corp. But do you really know what that means? So first, let's get to the definitions, okay? An LLC is a limited liability company. It is a legal business structure that provides personal liability protection while also offering flexibility in how the business is taxed. A single member LLC is taxed like a sole proprietor. So that means it's a pass-through income entity. So the business income passes through to your personal income. That's the reason why it's filed on your individual income taxes. So your Form 1040, and it's going to be filed on the Schedule C. A multi-member LLC is taxed like a partnership. LLCs are simple to form. They have a flexible management structure. You also have liability protection for the owners. No payroll is required, and there are less formalities than a corporation. So what is an S Corp? An S Corp is not a business entity. I'm going to say this again. Please hear me loud and clear. An S Corp is not a business entity. An S Corp is a tax election that you file through the IRS for them to tax you like a corporation. But your legal structure must be that of either an LLC or a C Corp. An S Corp is a very strong structure for growing a profitable business, and you can save thousands in self-employment tax. But it's best that you understand how it works and when it's best to choose an S Corp over an LLC. So there are two parts to an S Corp. Just to simplify it, there are two main parts to an S Corp, and that is salary and distribution. Salary is taxed, self-employment tax, payroll taxes. We'll get into the definition of those. And then the distribution is not taxed, payroll tax, self-employment tax. So what is self-employment tax or payroll tax? They're both Social Security and Medicare taxes, okay? So it's considered self-employment tax when you are an LLC and you're filing on the individual tax return, so it's pass-through income. It's considered self-employment tax. It's considered payroll taxes when you are an S Corp and you pay yourself as an employee of the business. It's payroll taxes. Okay, so this is how it works, okay? All businesses have to pay Social Security and Medicare tax, okay? Social Security taxes is 6.2%. Medicare tax is 1.45%. There are some income thresholds and limitations, but we're just going to keep it simple. 6.2%, 1.45%, okay? So if you are a general LLC, that means you're being taxed as a sole proprietor. It's that pass-through income that we talked about. That means you are both employer and employee. So that means you pay 6.2% in Social Security and 1.45% in Medicare tax as the employer. And you pay 6.2% and 1.45% as employee. You're double taxed. So together you're paying 15.3% in self-employment tax. So let's just break it down. Let's go through the numbers. So if your business makes $100,000 for the year, you are taxed self-employment taxes on the entire revenue of the business. That's $100,000. So that means you're paying 6.2% in Social Security, plus 1.45% in Medicare taxes as the employer, and you're paying 6.2% in Social Security and 1.45% in Medicare taxes as employee. That's a total of 15.3%. So on $100,000, you're paying $15,300 in self-employment tax. That's just as a general LLC, which means you're being taxed as a sole proprietor. It's that pass-through income that we talked about, okay? But if you elect to be taxed as an S Corp, that $100,000 that your business made, let's deduct $60,000 for your salary, okay? So that means that only that $60,000 is tax self-employment tax, and the $40,000 in profit is not tax self-employment tax. And the way that works is when you file your taxes, and this will be done quarterly, the business will pay 6.2% in Social Security tax, 1.45% in Medicare tax. That's filed quarterly, right? And then in payroll, just like a W-2, just like any other W-2 employee, when your taxes are withheld from your paycheck, they're withholding that 6.2% in Medicare. I'm sorry, the 6.2% in Social Security and the 1.45% in Medicare tax. So that 15.3% is only going towards the $60,000. And that's a total of $9,180. Okay. Now that $40,000 profit will not be taxed self-employment tax. So essentially you're saving $6,120 in this scenario. Okay. And that's not including, of course, when you do your write-offs off of your profit and all of that, that's completely different. Cause I think a lot of people misunderstand that. You are taxed self-employment tax regardless of your profits, regardless of your deductions, regardless of your write-offs. It is taxed based on the total revenue that the business made. So in this scenario, it was much more beneficial for you to pay yourself as an employee of the business, and you save $6,000 in self-employment tax. So I've actually set this up for a couple of my clients that hit the threshold that we discussed, because like I said, taxes is about strategy. So I would say that when your business is profiting consistently about $40,000 to $50,000, then that would be a good time for you to go ahead and elect to be taxed as an S Corp. And for one of my clients that we did this for, she personally had not received a refund in years. Her business always owed at the end of the year. So when we separate the two, we separated her individual taxes from the business. We elected for her business to be taxed as an S Corp. We set up her payroll. So automatically she was being paid as an employee of the business. And when you do that, just like any other W-2 employee, her payroll taxes are withheld during, the payroll process, right? So her Social Security tax, that 6.2% and the 1.45% in Medicare, as well as, of course, her federal income taxes, that's withheld from her paycheck. And then on the business end, 6.2% plus 1.45%, that's all being paid quarterly to the IRS. So that means that at the end of the year, what ended up happening for her is, because taxes were withheld on her individual income throughout the year, and her business was making those quarterly payments, her business ended up, zeroing out, which is what you want. You don't want to pay too much, and you don't want to have to owe at the end of the year, right? And then for her individual taxes, since the taxes had been paid, since taxes had been withheld throughout the year, she was able to receive a refund. So with her income, her dependents, her credits, and everything that was available to her, she received a refund for the first time. And she was able to clear that stress of tax debt. And we went ahead and strategized, and we took care of it through the year. So I'm telling you, when it's time, like I said, when your business is profiting at least $40,000 to $50,000, that is the best time to consult with your tax professional. Please consult with a tax professional that actually understands strategy, by the way, not just someone that's filing your taxes. Electing to be taxed as an S Corp can be very beneficial for your business if done correctly. If done incorrectly, then it'll cost you penalties, you'll receive letters from the IRS, and just unnecessary stress. So please consult with your tax professional. And like always, thank you for watching Business Vibes Only. Let's talk business later.
Wow.